Welcome to Commercial Real Estate Pro Network's CRE PN Radio. Thanks for joining us. My name is Jade Aaron Gross. This is the podcast focused on commercial real estate investment and risk management strategies. Weekly, we have conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Today's interview is sponsored by Building Insurance and Risk. When you invest in real estate, it pays to work with a real estate investor protection specialist to protect yourself and your investment from catastrophic loss. The experts at Building Insurance and Risk focus on real estate investor protection. They provide you with multiple insurance coverage offers and a side-by-side coverage comparison. To learn more, go to buildinginsurancerisk.com. Today, my guest is Anne Hollander. Anne is the CEO of Lobby CRE, a 30 capital company, and she is making an impression in CRE and tech as one of few CEOs with a background in both real estate operations and rapidly scaling technology companies. Anne is an expert in strategic planning. And in just a minute, we're going to speak with Anne Hollander about balancing return and risk with data-backed asset management. But first, a quick reminder. If you like our show, CRE PN Radio, there are a couple of things you can do to help us out. You can like, share, and subscribe. And as always, we encourage you to leave a comment. We love to hear from our listeners. Also, if you want to see how attractive our guests are, be sure to check out our YouTube channel. You can find us at Commercial Real Estate Pro Network. And while you're there, please subscribe. With that, I want to welcome my guest, Anne Hollander. Welcome to CRE PN Radio.
Thanks, Darren. It's great to be here with you today.
I'm really looking forward to our conversation. But before we get started, if you could take just a minute and share with the listeners a little bit about your background.
Absolutely. So I have been in this real estate space now for a little over 15 years and got my start first as a leasing agent in a small portfolio here in the Dallas-Fort Worth area. From there, I have worked with a number of real estate tech organizations. I own and invest in real estate myself, primarily focused here in the Dallas-Fort Worth area, and now serve as the CEO of Lobby CRE, as well as the Chief Strategy Officer of our larger parent organization, 30 Capital.
Awesome. So the Lobby CRE, can you tell us a little bit about what is the focus of a Lobby CRE and what does it provide as far as service and who are its clients?
Absolutely. I think this may be a great introduction for your audience to Lobby CRE, as we are relatively new inside of this market space. So Lobby CRE is an asset management platform that is designed to help manage and optimize NOI, cash flow, valuations, and ultimately the returns to the sponsor and investors. We're focused primarily in the asset management space. We believe that the asset manager in real estate organizations is the unsung hero to link together both the operational efficiencies as well as the financial strategy of what a real estate asset and investment look like. So very excited to provide some new capabilities to the asset management side of the house. Historically, they've been largely ignored and left to their own devices and their own technologies, workflows, and processes to go figure out, what do I need to do to maximize the returns that come back out of this investment?
Yeah, no, I've come to recognize myself the distinction. I think a lot of times depending on how a company operates or investor operates, a lot of times the operations management and the asset management are maybe lumped together, and they're truly two separate operations.
They absolutely are. We see property managers in particular very focused in finding the operational efficiencies. I mean, frankly, you want those people to be in front of the other folks within the building that they serve, whether that means office tenants, retail tenants, industrial tenants tends to be a little more centralized, but see this most often in the multifamily space. Versus an asset manager who needs to be thinking about, how do I return back what I need to the investors, not whether there's a broken pool pump or The common areas need to be cleaned up, or I need a new maintenance crew on site.
Right. No, very, very kind of a micro focus on the return kind of thing, and then push down to operations and make sure that happens. So let's talk about the current situation, markets, changing. We've got interest rates increasing. We've got kind of I don't know what to call it other than just kind of I've heard a lot of people refer to it as pencils down, just kind of like trying to figure out where things are and what. And it would seem to me that in this environment, the focus on net operating income and making sure you're not going backwards, but how to maintain or push your NOI upwards would be critical for any real estate investor to be successful. Um, how is it that Lobby CRE and asset managers can reduce the risk and push the net operating income up?
So I think that's the question on everybody's mind right now. So thank you for asking that. Certainly, in every conversation that I have with our clients, with my colleagues in this space, that is the number one question at the moment. The good news is that yes, it's pencils down, and I know for folks that are focused, as a transactional broker or focused in acquisitions, this can be a tough time for you because you're kind of twiddling your thumbs. You're looking at opportunities, you're looking at things, trying to get them to pencil. The good news in this is the pencil is not broken necessarily. And so we see this volatility right now as just an opportunity to reset or recalibrate what our expectations look like. So as part of this, when we talk about, in particular, driving NOI, really, this is all about increasing income and reducing your expenses. So the big news here is that the income side of this has cooled off quite a bit in a number of markets. Now, I'll be, honest here. Some markets have cooled off more than others. Other markets are still pushing. And so understanding the dynamics of your specific market or submarket is incredibly important to figuring out, okay, is this deal going to work, or is it going to pencil, or is it going to return what I need it to return to stay ahead? The other part of this is reducing expenses, which I don't think any of us are strangers to the supply chain disruptions that have affected us over the last several years. We're not strangers to the natural events that have happened, particularly in Texas and in Florida with hurricanes, energy issues, the number of insurance claims that have been processed in areas that have been hit harder by more natural disasters and natural events going on. I can speak here in Dallas, our insurance costs going up quite a bit year over year, as have property taxes. When we have tornadoes rip through a major metropolitan area, when we have windstorms with 80-mile-an-hour winds and above, it's pretty easy to see, exactly what is driving these insurance premiums to go up in particular. But insurance isn't the only piece of this either. Expenses across the board are up. And again, market to market, we can say trend-wise up, but within each market, anywhere from 8% increase to 20-25% increase year over year.
Yeah. No, I know. Just as the insurance part of the thing that got a lot of not happy to hear from me clients when I talked to them about the insurance increases, but it's kind of all over the place.
Mm-hmm.
So are there any specific, I mean, we talk about insurance and inflation. I mean, it's I think that's kind of just an accepted thing. You go to the grocery store, you go to the gas station, you go out to eat. I mean, my God, just everything seems to have increased in price. Are there any specific points that you are focused on, or that you see that operators can focus on to try and contain their cost? Or is it more about, property to property, market to market, or each individual situation is unique?
Yeah, great question there. So the number one thing that we advise is visibility more than anything else. It's very difficult to manage the things that you can't see and you can't manage overall. So getting this visibility, ideally in where you can have a real-time, daily, weekly, monthly look at what's going on at your individual property is incredibly important. This visibility can come also from the income side of the house as well, and to what your cash flow is looking like. So beginning to look at things that are happening below the line and making some strategic decisions about what makes sense in this kind of environment. For somebody who's just starting into a value add project, the timing is not great, frankly, for what that looks like. And so potentially delaying that, reducing the scope of what you're trying to do, and understanding what the financial impact is going to be incredibly important. But that holistic visibility to everything that's going on, not just operationally, but also with debt, with equity, and of course with risk, incredibly important for operators, owners, investors, frankly, everybody in the real estate space.
Yeah. So in the broader sense, not just on the property specific, but more like in the economy, are there specific points that you look to, or that you feel like investors and operators should focus on?
Sure. So here at 30 Capital, we're focused on a number of different aspects of performance. So the operational component, we focus on and have a deep level of experience inside of the capital markets. So really working with owners in particular and borrowers on debt and advising quite a bit on the right situations in which it's right to take on that kind of debt. We also advise on the equity standpoint, and we ourselves have been a principal for quite some time in the real estate space, more than 20 years at this point, investing in our own real estate assets. So as we look at this, right, we're bringing our own experiences to this. We're bringing our own background inside of managing real estate, and of course, squeezing out those returns, not just in the what I'll call the height of the cycle or the growth side of the cycle, where we're able to leverage a little bit more on appreciation, but also in the battening down of the hatches side of the cycle where we find ourselves today. Debt is a big unknown at the moment. We're seeing a ton of volatility. We're taking a look on a daily basis at what our forward curves look like and beginning to make some decisions in our own real estate assets, as well as future opportunities based on what these forward curves look like. We've created our own proprietary model on this, which has been not only a valuable project for us to take on, but something that's been incredibly valuable for our clients that we serve across 30 Capital, within 30 Capital Financial. So really, when I look at what the recommendation is, taking a look at the economic indicators in particular around debt, around inflation, and of course the demographic shifts that are happening as part of that, incredibly important to get a pulse on a regular basis.
Yeah. No, it's having some sort of a sense of a handle on it is, it seems like kind of a slippery handle right now, but are there any like more important, as far as the performance of a property or, are there any, indicators or metrics that you focus on more than others? Or is it, can you isolate them? We've talked about expenses and income, batting down the hatches, but is debt really kind of the focus point right now for most people, or is it?
Certainly is one of those areas where it's not particularly well understood from the bigger scheme of commercial real estate, and one of those opportunities where you can get yourself in over your head, particularly depending on the asset types. So we're beginning to see defaults, for example, in the office space. We have quite a bit of office space that, due to the work from home trends and some of the demographic shifts that we have seen, begin to take its toll, specifically within office. As part of this, we anticipate loan workouts and modifications to come through this, if not outright, defaults on the mortgage itself. So having that debt background, having that advisor by your side, particularly important in these times. For folks that are looking to do a deal today, making the decision about whether a fixed rate loan or a floating rate loan makes sense based on the equity position that you have is an incredibly important decision. Do you want to take on that risk and those costs up front in order to maximize your equity on the backside? Or do you put that off a bit, taking a little less risk with a fixed rate loan? Believe it or not, even with the volatility in the interest rate space, we still see people who are engaging in floating rate loans and taking those on for their new deals. And again, depending on the strategy and structure of how you're structuring this deal and what you're looking to return back out of it, that could be the smarter choice to go and do. Certainly, one of the topics that doesn't get a lot of attention today, but I think is going to, everybody's going to get a crash course pretty quickly here, are the unfunded cap liabilities. So exceeding the caps or the limits that you may have set on your floating rate debt, those liabilities beginning to show up in the space and causing quite a bit of economic and financial distress for a number of owners and investors in particular. So I think, as I take a look at this, really that holistic view of being able to put together what's going on operationally at the asset with the debt metrics and economic metrics, taking a look at forward curves with the equity position and returns that you're looking to achieve, and trying to find the balance within those in this time, while not easy, incredibly important for our asset managers to begin to go and look at. This is why Lobby CRE exists, is to bring those three things into balance with each other in order to maximize what those returns look like.
Yeah. You mentioned the capital requirements in that. I wonder if you could give kind of an example of what you're seeing or what you expect to see as far as how that plays out.
I think it's completely deal dependent and then strategy dependent within that. So there are a number of different ways that this could potentially play out, depending on the asset type, depending on the asset class, depending on the market and submarket, depending on the demographics for the asset itself. And then, of course, the underlying factors within this as well. As we see office spaces begin to move into distress and default, and folks not moving into offices or going to work inside of offices like they did, tenants beginning to move out or reduce the size and scope of the space that they have. This is not an isolated thing. This begins to put stress on the financial system or the banks and lenders who have loaned out that particular money, right? And we begin to see this chain reaction happening. With the additional stress that lenders and banks have then as part of this, the next step begins to happen where they tighten up their lines of credit, which then begins to affect a number of other industries in addition to commercial real estate. So, I don't think that we can look at commercial real estate as a single isolated thing. This is instead one of the dominoes that has quite a bit of chain reaction that comes back out of that. The same could be said for multifamily as well. This has been the darling of the commercial real estate space over the last market cycle. And just last week, I was talking with colleagues of mine on a panel during an event that we were at, and asked the question, is multifamily still the smart bet, or is it the default bet at this point? And the panelists in taking on that question, basically said it's probably still both. But we're really, really, really looking hard at the multifamily deals right now to make sure that this is going to return what we need it to return. Multifamily dwellers need that additional retail and office presence in and around them. We have seen that they don't want to commute the way that they used to, and they don't want to have to go more than about a 10-15 minute drive in particular to the next thing that they need to go and do, whether that be work, whether that be retail, whether that be entertainment, whatever that is. If things begin to shut down in those particular spaces, new development is not happening, redevelopment is not happening, then an impact to multifamily becomes particularly difficult to get to a place where you can return what you're looking for out of that property.
Yeah, it is kind of crazy when you look at the interrelation between all of the different asset classes, and then also the lenders and the real estate market. And, like you said, just the domino effect. I mean, I think a lot of people, focus on what they're doing and what they're trying to accomplish, but may not understand the relationship between all of the different players and how it all plays out. And it is scary, I think, sometimes when you look at how interrelated it is and how, if one is weak, how it can, set up a collapse for not only that one, aspect or asset class or property or whatever, but how it can have a effect, back to the banks and even the market you're in, kind of thing. It is it is interesting. It is interesting.
Yep.
So as far as trying to push the performance for a portfolio, what are some of the opportunities or the performance levers, or what do you see that the uh, the asset managers have available to them in order to push the performance of a portfolio?
Sure. So today, most asset managers that I talk to are trying to centralize or consolidate as much data as they can from as many different sources as they can. And one of the friction points of this is that that's entirely manual today. I don't think anybody here is a stranger to Microsoft Excel. But essentially, we are running our businesses and putting all of our trust into a tool that was designed to not to necessarily bring together that much amount of data and do that analysis, but has no background whatsoever in what do we need to be looking at within real estate space, creating the models that you need to see, reforecasting out what a pro forma can potentially look like in this particular dynamic, all very, very important from a tool perspective. And what we see are asset managers who, for no fault of their own, are leveraging models that were created 10, 15 years ago, wouldn't know necessarily if a particular formula was broken in that Excel spreadsheet, don't know where that model is being distributed to or who has access to it, which may have some sensitive information in it, particularly if you're including your cap table in it. As well as the fact that the data that's coming in is in no way streamlined. One data source may define occupancy in one way, another data source may define occupancy in another, which sounds completely insane until you begin to look to say, okay, well, they defined occupancy as physical occupancy, not economic occupancy. I need economic occupancy. Well, this other data source doesn't have economic occupancy. They only have physical occupancy. So can I really even use these as a basis of comparison, let alone actually trying to bring in all of this data? We have a timeliness issue of data as well. In many cases, data is being reported back, 45 days, 60 days out for operational perspective. And in benchmark data, oftentimes, typically a year can go by before you have fresh data to go and actually look at. So there are some risks that go into this as you're beginning to try to evaluate what your portfolio performance is today, as well as what it could be in the future. Lobby CRE in particular solves a lot of this because we handle a lot of that data centralization, bringing together the pro forma, as well as some modeling tools that come with this, beginning to centralize the operational data from the property management systems and other tools that are being used at the property level, seeing all of your debt information, bringing in forward curve data in order to help model out and optimize what debt looks like. And then, of course, with equity of being able to manage all of your investors that maybe is part of this. And using those tools all together to help model out what is it that I need to do to get to the cash flow that I need to see, particularly important in this day and age, as well as the returns that need to come back out to my investors. Investors at the end of the day are the types of human beings who want to understand when and how much return they're going to receive. The when being a big part of this, and the how much being particularly important as well. We may have gone into deals that aren't going to be able to return what we had initially expected. So communicating back out and having confidence in what you're communicating back out, particularly important in this dynamic.
Yeah, no doubt. So let me ask you, at Lobby CRE, is the data or the data points, can you customize which data points you're choosing from, or is that something that's pre-selected by Lobby CRE?
Yeah, so we feature more than 500 metrics directly within the system itself. So you can choose what you want to look at. And I know that you asked me the question earlier around, what specific data points do we need to be looking at? I think that's highly dependent on the strategy of the asset itself. A lease up is going to operate differently than something that's stabilized. Something in a core is going to be different than a new development that you may be working on or building. Value add is going to have a different strategy, and you may be looking at different metrics as part of this to help assess operationally how effective am I at driving the NOI and cash that I need, and then of course how efficient am I in doing this. There's a number of opportunities for efficiencies, particularly within the commercial real estate space, and I think that we're going to be over the next 3 to 5 years very, very focused on driving those efficiencies inside of our organizations.
Yeah, no, I think that's 3 to 5 years is, I think that's pretty accurate, I think. Let me ask you, so the 500 data points and the fact that everybody can kind of focus in on what's important to their situation. You mentioned how some of the stuff or some of the data that's available is, almost a year old, or how it may not be as current, and not just what you have, but just the way the market and the data works out there. Is there anything that's like specific to the on the street for the market you're in, or how, meaning that, like, you talked about how different markets and different areas, and there's some markets that have totally fallen off as far as income gains, whereas some are still able to hold. Is how customizable is the thing for just your specific area? I mean, or does it pick up data from right where you are?
Yeah, so we'll pick up data from right where you are, and with some additional tools that we have connected with Lobby CRE, the ability to do what we call peer-to-peer comps or comparables in the space becomes very, very easy. No more of a manual process anymore. Instead, you can set those up directly within the system and then have them run so that you can see every quarter, let's say, exactly how you're doing against the comps in your market. This is going to provide you a level of detail that a lot of organizations don't necessarily have today, or where they do have it, prohibitively expensive to go and do so. We're also not having to rely then on a property manager to pick up the phone and try to secret shop who the comps are of what's going on. We know that property managers all know one another. We know that they're going to report back whatever it is that they want to report back. So keeping an eye on this and removing that from their plate so that they can go and focus on all of the other things that we need to do operationally to be as efficient as possible. Incredibly important to driving those ultimate efficiencies for the organization.
So how is it? How are you able to? How is Lobby CRE able to get that information without having the secret shopper property manager do that?
Sure. So we connect directly into the property management systems where our clients are handling a lot of their day-to-day data. So we're seeing that day-to-day about the asset. For data specifically, what I would call around the asset, where we're starting to get into demographics and other things. This is a mix of data that's coming from everything from lender reporting to on the CMBS side, to demographic data that's coming in through census, to more localized data sources where we can find it through other technology organizations who are opening up their data flows so that Lobby CRE can use them, and so that Lobby CRE clients can utilize that.
Cool. And so is that part of the agreement then for the users, is that the data will be shared, or that there is a reporting point, not necessarily identifying their data, but some sort of a market data, or how's that work?
Yeah, so great question. And this is certainly, one of my areas where I like to climb up on the soapbox. Historically, in the commercial real estate space, technology providers have taken ownership over the data that flows through their systems or their tools. So where a property manager or an asset manager, an owner, an investor, et cetera, use technology today, the technology vendor that they're using oftentimes is claiming ownership of the particular data so that they can go and do anything else with it. Here at Lobby CRE, we give that right back to whoever it is that's using the system. And so they can decide directly, do I want to share this in an anonymized fashion to create this market level reporting? There are benefits in doing so, of course. We have a product, the income and expense benchmark, where we have partnered with the National Apartment Association, the Building Owners and Managers Association, the Institute of Real Estate Management, among other organizations, to provide a benchmark, a market side benchmark that has the ability to filter down quite a bit, where if you're contributing data to this benchmark, you receive that benchmark for free. That said, your data may be more important to you than that benchmark itself, and you have full rights and access to turn off that data flow. We see this instead as an opt-in to this program rather than an opt-out.
No, I would think that just the overall the sense of that it's not Lobby CRE's data, but it's a shared data type thing amongst the subscribers would be a welcome thing, as opposed to that's mine, you got to pay for it.
That's mine, you've got to pay for it. I'm going to create other
Yeah.
products that leverage all of your data that I'm then going to charge you for again and again
Yeah.
and again, right?
Yeah, thank you for subscribing, and thank you for giving me all your data. Now I'm going to sell it. So.
Sell it to you and sell it to
Yeah.
everybody else.
Yeah. No, that's good. So, historically, I would think that more of your institutional firms would be more attuned to this kind of a data platform. Is it available to small and mid-size operators?
We focus almost exclusively on smaller mid-market operators in particular. So with this, right, these are institutional grade capabilities, to your point, but making them much easier to use and much more available to the mid-market space is really where we're focused. I don't see us necessarily stretching up into the institutional space from the Lobby CRE perspective. There's no shortage of opportunity here in the mid-market to provide these kinds of capabilities at a very effective price point to do so.
Got it. And is there a sweet spot? You said the mid, is that typically the client, and how would you define the mid-market operator as far as the sweet spot of a customer for Lobby CRE?
So generally speaking, less than 5 or 6 billion in AUM, the mid-market space. We have some clients that start fresh. They've been in the real estate space a while. They were able to hit the height of the market, sell everything off, and are beginning to build back. And they want to take on that first asset with the workflows and technology in place where they know that they can drive the most amount of efficiency out of that particular investment. And so they'll start with just one asset on the platform as they begin to grow their portfolio. I'd say our sweet spot overall, typically between 10 and 50 assets. We do have the capability to stretch much higher than that. And we do have some larger clients than what that is. But certainly, when you get to a place where you're trying to manage multiple assets at the same time and see everything all together, this provides you not only the opportunity to maximize the cash flow that you have to help fuel your growth, but also find the efficiencies that you need. It's really just throwing gasoline on the fire when you're thinking about the growth of your portfolio.
Right. And I think a lot of times when I think of different data or not data, but platforms, digital platforms for investors, property owners to use, I tend to think more of like the property management type software based on it's the operations kind of thing. Yeah. But this is entirely different, more of like a step back and a larger kind of a view of things and how to then affect the operations, if I'm understanding it right.
That's right. So being able to optimize across the asset, the debt, and the equity positions together rather than individual or isolated from each other.
Got it. Hey, Anne, if we could, I'd like to shift gears here for a second. By day, I'm an insurance broker, and as such, I work with my clients to assess risk and determine what to do with the risk. And there's three strategies we typically look to. We first look to see if there's a way we can avoid the risk. If that's not an option, then we look to see if there's a way we can minimize the risk. And when we cannot avoid nor minimize the risk, we look to see if there's a way we can transfer the risk. And that's what an insurance policy is. It's a risk transfer vehicle. And as such, I like to ask my guests if they can look at their own situation. It could be your clients, your investors, the market, your firm, however you'd like to frame the question. But if you can take a look at whatever that is you want to identify, and identify what you consider to be the biggest risk. And again, for clarification, while I am an insurance broker, I am not necessarily looking for an insurance-related answer. And so if you're willing, I'd like to ask you, Anne Hollander, what is the biggest risk?
I am happy to take on this challenge. Over the course of our conversation, I think we've talked about a number of areas of risk, right? We're seeing expense growth quite a bit in the operations, which frankly is a lot of ways the silent killer. We've talked some about the debt side of this and understanding your positions within debt and understanding at a much deeper level where you sit today and what risk you're taking on within the debt that you have, either existing today on your existing assets or in the future as you're doing deals. Frankly, when I begin to look at, I think there's also equity risk as well for unexpected capital calls. If the two in asset and debt aren't mitigated particularly well. So opening up new risks potentially on the equity side and either not being able to return as much as you're expecting or potentially even being underwater in what those returns look like. The three of these things, though, can all be also the other uncovered risk or perhaps the area that we haven't talked about at this point is the fact that a lot of information is being sent around quite a bit very freely and openly within an organization and then outside of the walls of the organization that can be highly sensitive or particularly damaging to organizations. If you think about, okay, when was the last time that I took a look at my models that I had all of my investor information in it, and it's all sitting in Excel. Excel can't be secured. We don't necessarily know where it goes, who it's shared with. We don't know how they access things. We don't know if somebody is modifying something within that document, sending it back, sending it around. And so Excel becomes essentially a game of telephone where everybody's got their hands on it and hands in it. For the most part, fairly innocuous, but not in a place where we can necessarily even assess what, if anything, has changed or if information has been borrowed or stolen back out of that document as well. I think the one thing that we don't talk about much in the commercial real estate space is the technology risk and the data risks that people run when they're using, tools that seem extremely convenient, but then have a complete lack of any level of accountability to them. Excel being probably the number one offender, other potential tools also an offender as well.
Yeah, no, that transfer of information and that sharing of documents and all that. That's a big problem, especially like if everybody has the ability to edit the document. You're setting yourself up.
Or find ways to edit it, right? I've been sent locked documents before that I can log into, edit it, or save a copy of it, edit it, and then send that copy back out with the same thing. And I could do that in less than 10 minutes.
Yeah, no, that's always the even in that instance, there's no harm meant, but just the fact how that can change the whole model or whatever the expected outcome is. That's and how it could affect somebody's decision to act or do something. That's pretty scary.
I can strip investor information such as bank accounts, social security numbers, EINs, etc., out of these documents that are being sent around. It's truly amazing to me how willing we are to share all of this data with other folks, but then don't or get surprised perhaps when something doesn't quite come back the same way that we thought it was going to.
Yeah, no, it is a scary time, and just how fluid the information is and how sensitive it is, and how much trouble it can create. It is a problem. And I don't know how you get back to, I mean, you go through all the dual authentication kind of situations. And I mean, it just seems like it's very cumbersome and stuff. And but that's what we need if you're going to try and be secure, or some sort of a platform that's secure, whether you got to log in and that information is held on that platform there, I guess. And then I assume that's kind of what you guys have available on yours.
We
That's what-
do, yes. Yeah, we got full access control, limits and permissions on what data can be accessed. And then, of course, the full logs of who's doing what within the platform.
There you go. Got the logs. That's the who did this. That's great. Well, hey, Anne, where can listeners go if they would like to learn more or connect with you?
Absolutely. So I would point your listeners to lobbycre.com, get an understanding of how Lobby CRE can help your organization. Certainly, I'm active on LinkedIn, so find me there. I'm just linkedin.in/Anne Hollander. So you'll find me there, as well as Twitter. I've gotten back on the Twitter bandwagon as of a few weeks ago. So
All right. Well,
there.
it's all safe on the Twitter there. So there you go. That's good. So, well, Anne Hollander, I can't say thanks enough for taking the time to talk today. I've enjoyed it, learned a lot, and look forward to doing it again soon.
Thank you, Darren.
All right. For our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.